In this episode, we're going to be talking about use cases for the scanner with examples and strategy. So let's dive in. There's a lot to cover. The first thing is I want to show you some real world use cases of how we're using the data to see what the market's doing. Because the data, in my opinion, is it's like the most important part to the strat. And Rob would say the same thing. Simultaneous breaks are what make the strat work so well. And what does that mean? Well, it means the strat lets us know definitively, are things going up or down? If we have a 2 up this week, it's going up this week, right? If we have a 2 down, it's going down. The question then is, how much evidence do you have it's going up or down? Is it really green or really red on the week? And then how much of the market is going up or down in that direction? Because SPY could be a 2 up week, but you could only have 10% of the SPY going 2 up. It's not really strong. Or you could have a 2 up week on SPY with 95% of the market going up this week. That's a really strong 2. It's definitely going higher at that point. So in this example here, we had recent EU news / Apple news, and the whole market gapped down. So when we go to the SPY, we'll see the whole market opened lower, right? And everyone's like, oh, this news is terrible. With the strat, what we saw is it all opened lower and then everything went green on the day, which tells us what? They're buying the gap down. They're rejecting the gap down. And we know the market trades in rejections because broadening formation exists. You make a new high, you reject it, you make a new low. You make a new low, you reject it, you make a new high. So if we gap down, and then we can see, this was a little later in the day, about 142, but we can see on the scanner, 70% of SPY, 76% of the Qs gap down. But notice on the sectors, utilities was already going up. Energies was already going up. And then industrials, although they were mostly 2s down, notice this bar here. It's showing green. So all of those 2s down were green, is what that tells me. Same with materials. Same with real estates. Most are green. All of financials are green. Cyclicals, staples, healthcares, and then almost all of tech. So what does that tell us? It tells us 90% or more of the market rejected it because there was some stuff going up, 16% of the SPY, 7% of the NASDAQ. And then a lot of those 2s down were rejecting the downside move by going green. So how do we then apply that to what we're going to do? Well, since we know most of the market's 2 down and green, we can expect potentially an 80 to 90% market up day with 2-2 reversals at the open the next trading day, which is on Tuesday the next week because we had the Memorial Day market holiday. Then we saw it gap up. So our analysis was correct. Over the weekend, they gapped it all up. That whole market rejected the downside move and then gapped up to start the week. When the market gapped up, we saw 95% of the NASDAQ going up. That's almost the whole NASDAQ going up. And then we saw almost 90% of the SPY going up within 15 minutes of the open. And then when we look at the market here, you'll see some of these were red. This was right near the open. But the whole market just went from like 90, 80% down to 90% up. The whole market just reversed. So this is one of the main ways we use it. When the whole market reverses, we're in. It's going, right? And then what does that look like? Well, if you're a futures trader, this also helps you. So Sarah in the morning, this was 3 minutes after we mentioned, hey, the whole market just reversed. She entered the 15-minute 2-2 reversal, which I can try and zoom into this. You'll see the 15-minute 2-2 reversal here after alerting it to our premium section. This is one of 3 alerts this week. Then the 30-minute broke. So you could buy it and then add to it because the whole market's going up. You're going to add. And then it goes right into the new highs, which is our target, 75 points on the NASDAQ with 95% of the NASDAQ confirming that direction. And then it kept going, right? Not only did it do that, but when you have that amount of evidence, if we go back to the 15-minute and look, what you're going to see is when that occurred, when that occurred, not only did it hit the highs, but it kept going because the whole market was going up. Now, the biggest thing you have to understand then is how long does that evidence last for? So because this was a daily example, we had all day to go after it. And just to give you a view, this is when we posted it and when we identified that was true. This was true at the open, but we posted about 15 minutes after, letting them open slightly. Now, that lasts all day, right? So the next trading day, that data completely resets because each day confirms what's happening or negates. So as the week went on, you'll see today, about 60% of the SPY and NASDAQ went down today. So most things went down today. Therefore, that buying that was occurring was no longer happening. But this is really powerful, not just on a daily, but every time frame. So in today's example, we identified during the trading day that we had simultaneous inside 60s across the market. This was 4 minutes before the new 60-minute bars opened. What does that mean? Well, when you get a simultaneous 1, what that means is you're about to get a scenario 2, because after an equilibrium or a consolidation, you must trend. It has to do that, or else the market would go scenario 1 and go sideways forever, which we know doesn't happen. So in this case, the second 60 of the day, SPY, you'll see went inside 60. Similar to the last video, once we find that, we have 60 minutes to wait for that to set up. Then we can draw our broadening formation out. We can say, if this breaks to the upside, we'd look to target the highs. If it breaks down, we have this pivot, and this pivot to take out as a simultaneous break. When that broke, we had about 50% of the market break inside 60 down or 2 to the downside. Within the first, it was like 15 minutes of the break. Then they confirmed it by going down further, and we had about 80% of the market breaking, which caused us to make the new lows. What did that create, negate, or do? Well, it confirmed the day was red. What did it do? It caused a scenario 3 on the day, which is our target. And then that was it. Because once this went scenario 3, it's a broadening formation. You'll see they make the new low, and then they come back into the broadening formation and rally the other way. So what we did is we took it on the 60 break. Then once it made the low, we covered our position, and we said you could try and flip it long to make some other money on the way up if you wanted to. And you had a nice rally. So this is how we can use data to support our trades and to find the trades. And in this case, we had about 600 of the 1,000 stocks we track that were a scenario 1 on the 60 minute. The next example I want to go over is the staples. So if you've been following us at all, you'll see us talk about defensive posturing versus, like non-defensive market posturing. And what that means is when they're buying staples and utility stocks, the market is defensive. When they are selling those staples and utilities and buying tech and buying semiconductors and buying, discretionary stocks, the market is more aggressively investing. So what we'll see is this. So you can see this is an example from the scanner. So when the market's going to pull back, meaning it's not going to crash, what will happen is you'll see the algorithms, which account for 70% of trading volume, go from buying tech and semis and discretionary and financials to selling some of those. Some will still keep going up. Those are the leaders. And then they'll start buying things like the non-cyclicals, which is your staples. And then they'll start buying, sometimes real estate, sometimes not. And then they'll start buying utilities. So utilities and staples, when those are going up, we call it defensive posturing. So you can see this was at, May 15th, 2025. We identified, hey, market today, SPY, you can see some down, some up, Qs, some down, some up. This is defensive posturing. They're rotating out of the laggards. The stronger things are still going up, and they're buying utilities and staples. So when we go and then look, you'll see when we identified that defensive posturing, it was right in here at the open. This is about 20 minutes into the trading day. So up they go. Here's the staples sector. This was that defensive posturing, identifying algorithmic buying while the market pulls back. If we go to the utilities, you'll see utilities, they were already going up. So they reversed. This was that 2-2 day I showed you in the previous examples in the previous episode. But you're going to see they reversed, then they continued up. And then you'll see real estate's also reversed at the same time, and then up they go. So this is defensive posturing. We can pick that out just based on the data. And then the next thing is we know the data will confirm or negate. So if 80% of things reverse, either those continue to up the next day, confirming, and you see continuation of buying, you see like maybe 70, 80, 90% of those things still going up the next day, or they'll negate by reversing. So what we do is we monitor the data. So when staples reversed down in here, and we mentioned that, what we saw is 4 days of rally. Then we saw about 70% of the staples reversed on this 60-minute right here. What did that create, negate, or do? It negated the daily open. It did come back to green, but it did negate the daily open for a little bit. So what we said is this was profit taking of the 4-day rally we saw in staples. And we saw 70% of the staples get reversed. Now the leaders kept going. So we can hold things that didn't reverse. And we can do this on a daily basis, weekly, monthly, quarterly, yearly, 60 basis, doesn't matter. But we're watching mostly day and 60 and monitoring the week, the month, the quarter to identify where we should be. So in this example, if we go back to the staples, you'll see when that 60-minute occurred, 70% of them reversed. We want to ask, where is that happening? Because we don't want to do this in a vacuum. Well, it happened at the top of the daily broadening formation. So that was our first hint, hey, reduce. Then the next day, you'll see it reversed here on Thursday, up, up, up. The next day, 2-2 reversal down, get out or reduce your position heavily. Now things that didn't reverse. See stuff like Philip Morris. So we go to staples. This was Wednesday, right? So Wednesday on the 21st. Philip Morris on Wednesday, while the rest of them reversed, this one didn't. So you can see this reversed here Thursday with all the staples. Did not reverse Wednesday. They made a slight lower low, which was a reversal, and then they reclaimed it, and then they kept going for more days. This is what a leader will do. Leaders will not reverse when the rest reverse. And then when they do firm back up, so like when staples on Friday firms up again in here, you'll see Philip Morris on Friday goes flying to the highs because they're still buying it. We're identifying algorithmic trading. You just got to keep that in mind. Now, if we compare that to like MO, you'll see MO up, up, up. Wednesday, 2 down Thursday. It's not a leader. Now this may set up for next week, right? The inside week signal. So we'll be watching that and see for simultaneous breaks. But I'm just trying to show you how the data is going to tell you what you're looking for, and then how you can use that to hold your position. Say like, still good, it hasn't reversed, still good, still good. Then once they reverse, hold the leaders, but get out of the ones that reverse. That's our whole goal. Because at the end of the week, we want to be left with the biggest winning trades. So we want to get in Monday, Tuesday, Wednesday. And by the Friday, anything that reversed, we want to be out. Anything that's still going, we want to still hold. Now, as far as other examples, I have one more to show you. So this is an example of what a rally looks like. This is from an older version of the scanner, but you can still see the data. 83% up, 80% up, SPY and Qs. It's going up. Look at every sector. They're all confirming that. Every single sector. That's a really bullish market. They're buying everything. They don't care. What does that mean? That means that's definitely what a rally looks like. This was posted April 22nd, 2025. So let's just go to the charts and see where that post occurred. This occurred here, 5/22/30. And then you'll see until it reverses, it's considered still good. 2, 2, 2, 2, 2, 2, 2 down, but then goes green. 3, 2, 2, 2, 2 reversal, and then they continue. But at that point, you're in this gigantic winning trade. So you'll notice when we have high evidence, they tend to keep going. That's what the strat's all about. We want to find when we have the whole market reversing. In this case, 2 down, 2 up on a Tuesday, the whole market, and then hold until it reverses against us. Because if it doesn't, it'll just keep going. What does that look like? Well, let's say we go to weekly Philip Morris. So we saw a simultaneous break in staples. This was before we had the scanner, but we were scanning and we saw this 3-2-2 week. This went 2-2 here, set up. Then you'll see 2, 2, and then this slight tick down, but then 3 with earnings, 2, 2, 2, 3 against us. This is what we want to see, this big uptrend. And if we go to like meta on the quarter, at the beginning of 2023, meta went 2-2 reversal, and then 2, 2, 2, 2, 2, 2, 2, 2 reversal against here. And the beauty is once you do this, once you have this big winning trade, if it reverses against and you don't want to get out, you don't have to. It's only when you're in a losing position. So what we want to do is look for these simultaneous breaks on stocks we expect to keep going. So how do we do that? Well, that's where looking for monthly, quarterly, yearly signals comes in. Because, for example, SPY this month, if we go to the scanner, you'll see this past month, 70% of NASDAQ or 75%, and then 60% of SPY had reversed. Therefore, the market's going up, right? You know, staples not as strong, utilities not as strong, but tech, oh yeah, cyclicals, yep, financials, yep, industrials, yep. So all the strong sectors there. Because of that, we want to buy things that are above the yearly open and still going. So what does that look like? Well, when we look at SPY, this broke, right? The year was still red. Now it's green, barely, but the stronger things were already green on the year. What were the stronger things? Well, in this case, not here, hood. You'll see hood, for example, 2-month simultaneous break with the whole market breaking about 70%. When that occurs, this was already green on the year. And where is it going? Well, we reclaimed the lows. We're going back to the highs. So we can use the simultaneous breaks to say, hey, a lot of evidence. Give me the strongest stuff you got, right? Here's another example. Chewy, 2-month. When that breaks, what does it do? It causes a yearly reversal that lasts another 7 months above this. So we take those simultaneous breaks into things we can expect to keep going. Or we can just trade them separately and say, I'm going to buy the break. When it reverses, I'm going to get out. There's many ways to do the strat. It depends on what type of trader you are. I've shown you intraday. I've shown you identifying, rotation on a daily basis. And I've also showed you how we can identify like the big moves when the whole market reverses on a daily basis. The same thing applies to the monthlies, as I've just shown you here as well. So it really depends on what type of trader you are. But at the end of the day, we're looking for simultaneous breaks with tons of evidence. And unless they reverse, we want to hold it. And that's the gist. So as far as entry and exit is concerned, we enter when it breaks. If it's a simultaneous break, we hold it until it reverses. Because it might reverse, 2 points higher. It might reverse 200 points higher. We're not sure. We just know we have a lot of evidence of a buyer. And then exiting is the same thing. We want to hold it till it reverses, right? And then once you have the evidence, if you have your positions, like let's say you have 5-10 stocks you're looking at, you're like, I'm in these, right? 100 tech stocks break. I picked my 10 stocks. What you can do is say you have a monthly break for a whole month. Every 60 and daily signal on there confirms it. So you can go and scan like we showed you in the previous. You can take your list of stocks and only trade the daily and 60 setups on those stocks. And there you go. You have your whole strategy planned out for you. So that covers most of, strategy examples, seeing the data. As far as scanning strategies are concerned, there's a few things we look for, which is 2-2 on a Tuesday. We'd like to see a 2-2 reversal on a Tuesday. If it occurs on a Wednesday as a simultaneous break, that's fine. Right? A Thursday, Friday, that's fine. But we like Tuesday because it's how you cause weekly signals to break early in the week. And it's also how you cause outside bars to occur on higher time frames, such as a weekly. So a 2-2 on the second day of the week, the second week of the month, the second month of the year, the second quarter of the year. Those are one of the things we look for. So you can just trade 2-2s on a Tuesday looking for simultaneous breaks and have a good time. We also look at the inside bars or the equilibriums. On Monday night, so for Tuesday morning, we look at all the inside days and we use those inside bars to confirm monthly signals and quarterly signals, or to break weekly and monthly and quarterly signals. So those are like the two main things we're scanning all the time is 2-2 reversals setting up and inside bars setting up. And we're trying to match the simultaneous break with those and trade where we have 90% of the market breaking at the same time. And that brings our trading from, maybe, maybe not to definitively that's happening. We're in and it's going up there to our magnitude. So hopefully you guys enjoyed this. The last part of this series is just going to be wrapping up. So hopefully you guys enjoyed the series so far and adios.